Now, Ryan, we might just go back to the Lloyd's position. Now, my understanding was that there wasn't a hell of a lot of players willing to take on financial planning type risks in the first place. Now that we've got Lloyd's or a number of syndicates within Lloyd's pulling out of that market, what sort of impact is that having on, indeed, being able to approach potential insurers?
I think it has a huge impact, and I mean we sort of witnessed that and experienced that throughout your renewal when one of the Lloyd syndicates, who was one of the insurers and one of the lead insurers on your program, went into runoff, and therefore when they go into runoff, they have no capabilities and no capacity to provide any solution whatsoever moving forward. So you have to find a replacement for that lead insurer or for that excess capacity wherever they're sitting on the program. And I mean, Lloyd's were quite a large player in this market over the past few years. I mean, you had markets such as Antares, Manchester Underwriting, Landmark Underwriting, Acapella, who have now all gone into runoff. So, I mean, they were big capacity providers, and where you have to replace that capacity with is the local markets. And what we're finding is, as I said earlier, we are in a hard cycle. So what are sort of, I suppose, features of a hard cycle are premium increases, are excess increases, are reductions in limits, but also reductions and restrictions in appetite from insurers. And that's what we're finding. We're finding that when we're taking what was a London-led risk into the local market, you know, it's very difficult to secure capacity and a premium rate at the same level as what the London market was charging with the local market in the current environment that we're in. So through these London syndicates going into runoff, and especially these London syndicates which led some of these programs, it does create quite a difficult situation, because the local capacity, the local providers, the local insurers do have the capacity to provide a solution. However, their underwriting guidelines and their underwriting, I suppose, restrictions have increased. So the types of businesses that they're now looking to provide capacity to has reduced and has, I suppose, gone to more a limited state. So, for example, some insurers that used to write dealer groups and used to write large dealer groups as new business will no longer write them, or they will look at them very carefully, and you will need to go through a very extensive process in order to even get considered by one of these local insurers for them to deploy capacity and provide a solution. So, yeah, the effect of London and those Lloyd syndicates removing themselves from the market could have quite dramatic and material effects.
Yeah, well, I guess we sort of experienced that firsthand, I suppose, where our existing insurers pulled the pin, and then a lot of the other insurers that did have capacity, well, that were still in the game, had basically said, well, they'd wound back capacity to satisfy how they were going to stay in the game, if that makes sense. So whilst a lot of the guys were saying, well, we're happy to renew existing insurers risks, they're not necessarily looking for new risks. Would that be a fair statement?
Yeah, that's exactly right. I mean, I think the feedback and the communications that we're getting from insurers at the moment is they're in a consolidation phase with their portfolios in this space. And obviously, with the uncertainty that COVID brings, for them to bring on any new business and deploy any new capacity in this area, they need to be extremely comfortable with the risk and extremely comfortable with the policies and procedures and risk management and mitigants that company has in place. But even if that company has that all in place and is a quality business and has a clean claims record, there's no guarantee that any one of these local insurers is going to provide capacity, because they are in as I said, a consolidation phase. And what they're doing is they're trying to balance out their portfolios to ensure that they're not taking on any new business that could lead to enhanced risk in this unknown period that COVID brings. what we're also seeing with the local insurers is PI, especially around financial services, is on the radar of everyone. And that includes the radar of their head offices, and some of their head offices are based overseas. So on some of these lines of business, especially if they're taking a primary position, they require head office sign-off as well. So the whole process of what you need to go through now to secure an outcome is extremely, I suppose, what's the word I'm looking for, detailed, and takes a significant amount of time. And there is no guarantee. You know, I mean, as I said before, there are local insurers that have previously provided solutions for new capacity in regards to dealer groups or in regards to other areas of concern, such as MDAs that insurers may have. And you know, as recent as 2 months ago, they've now looked at their underwriting strategy and restricted that even further. So I think businesses that are going through the renewal process in the next 3 to 6 months that aren't a vanilla business and aren't an employee-based financial planning business with a pretty vanilla product list may see some difficulty.